Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. Okay, an exciting week of central bank action. So let's start there. Jan, let's start with you. I guess probably goes without saying for anyone listening to this pod that the Fed hiked 25 basis points, which was really as expected, I suppose. What else did we learn from the press conference and the rhetoric yesterday?
Like you said, Imogen, they did drop they did hike the interest rates. I'm kind of having like a Freudian slip here, but they did hike interest rates by 25 basis points from to 5.25 range, which we believe will be the final hike for this cycle. And we did see that in the policy statement too, which was slightly more dovish as they adjusted the line, they dropped the line which said some more policy firming may be appropriate. And Powell addressed that in his Q&A later on, saying, well, as you see, we've got rid of that. So now we're going to assess the cumulative impacts of policy tightening as opposed to just, hiking not blindly by default at the next meeting. So now I think markets have rightfully taken away that this was the final hike, and we've in fact moved on and priced in further cuts into the forward space. So on the back of what we got from the Fed, we actually adjusted our Fed call too. Now we've pulled cuts for Q4 from Q1 next year. We expect 50 basis points of interest rate cuts at the end of the year. I should point out this is well priced in markets by this point, but we do see risks as those cuts being priced even further, particularly on the back of what's been going on within the banking sector and the credit sector these past days. But we have pulled our forecast for earlier. That comes on the back of, like I said, not just the credit stuff, but our inflation forecasts now are pointing to a direction that would give Fed enough comfort and headroom to be able to pivot and kind of like not still be in restrictive zone, but less restrictive if you think about it. 5.25, still well above their neutral estimate of 2.5, which hasn't changed throughout the pandemic. So if even if they were to go to, and I'm giving random numbers here, like 3%, in theory they're still in net tightening zone according to their framework. So we do expect cuts at the end of the year. And what does that mean for rates? Well, because of how markets love chasing the next theme, the next idea, and now it's, well, when will cuts come, how big they will be, and how much insurance do we need to price in the cut? We believe curves will continue to steepen. We believe duration will perform well. And I think last week's podcast, we also discussed how owning fixed income, risk-free core fixed income into the final hike and following through that has been a pretty profitable strategy. And we don't think it will be any different this time around. So we see further upside for treasuries, particularly in the sectors like 3 to 5 year point. We see cyclically steepening curves in the US, and that would be like the bull steepening. So led by a drop in expectations, both in terminal rate, but also possibility of a faster and earlier Fed pivot.
How much of bringing forward that Fed cut pricing, we're going to have to be so careful now to say cuts instead of hikes, aren't we? I think we're going to get that wrong like 100 times probably on this pod. But how much of bringing forward that Fed cut pricing is about your assessment of financial stability risks, which have obviously been kind of back front and center over the past couple of days? And how much of that is just about, I guess, a weakening growth outlook and inflation coming quickly back down to the Fed's target?
I would say a lot of the updates of pulling it earlier now is on the back of what we think will be an inevitable credit crunch coming to the US. And in our conversations, a pushback that we get often, which is completely understandable, is that, well, this is not 2008. And we also don't want to draw a parallel to 2008. We don't really think it's going to be anything of that magnitude, but each crisis is unique in its own nature. And we do think that going forward, it is hard to see how what's been going on over the past month and a half now will be resolved, particularly as in situations like bank runs and just generally like crises that are driven by fear, a lot of the fundamentals take a backstage. So we are hopeful that nothing goes wrong, but we do believe that it will be hard to see how these credit lending standards generally don't tighten. We will see that with the senior loan officer survey on Monday, or as we mocked it plentifully last time, the SLUs on Monday when they come out. So we will recap that next week. But it is mostly on the back of the expectation of slowdown in credit, which for us is very key for both growth and inflation. But again, to your point, our inflation forecast and growth forecast also factor in a lot, because at some point a central bank can't really operate only on the back of what they've seen from last month's inflation print. If you have sustainable path towards your target, so the 2% target month on month, you can, in our view, you can just skip the yearly numbers and just focus and be like, okay, we're in the right track. Monetary policy operates with lags, so you don't want to overshoot the other side too. I know it's too early to talk about any form of like deflation or disinflation, but you don't want to get to a position where like, oh, we actually overdid it, so now the impact of that's going to kick in over the next year or something like that. So to answer your question, both, but mostly.
Okay, nice. Thank you. And I guess before we move away from the US, it wasn't just about central banks this week, because we also had the quarterly refunding announcement, which usually, well, I'm saying this as a UK rate strategist, so I'm probably a bit biased, but I was going to say usually isn't that exciting. But we obviously had this surprise announcement this week where plans of buybacks were sort of future plans for buybacks were sort of pre-announced. What is that all about, and what does that really mean for markets?
Right. So like you said, it's often not the most exciting topic, but I think this time around, it's worth touching upon. Really three main things from this refunding. As we expected, they didn't really change the sizes in auctions for this quarter. However, the Treasury did indicate that we might see an increase in coupon offering sizes even as early as August. Of course, that's conditional on the debt ceiling being resolved. And I imagine what went into their forecast was, well, once the debt ceiling is resolved, you're going to have a very large amount of Treasury bills issued, and you kind of want to turn those out too. So if they increase kind of the longer term debt offering sizes, that will take away, or in theory, bring down the percentage of bills as outstanding debt. And the second, of course, ever persistent theme, the US deficits keep growing, so you need to fund those somehow. You can't really roll them over through with equivalent of like 3-month debt. You need to term it out, and historically intermediate issuance, or at least over the last 5 to 7 years, Treasury's framework has been that the intermediate part of the curve offers the best kind of bang for your buck, we should say, for funding needs. The second thing that was important, like you pointed out, buybacks were announced. That was a little bit of a surprise to us, because by most metrics, liquidity is not, it's not as good as it was, let's say, 2 years ago, but it's certainly improved compared to the end of last year when the buybacks were floated for the first time. Treasury did say that buybacks would start in 2024. They will be done with two main purposes. One of them is for liquidity enhancement. So Treasury would presumably buy off the run securities and fund that with issuance of new on the run securities and try to keep that close to duration neutral. And also for cash management purposes. That's similar to how a lot of, for example, like Italy does something similar, where they would buy things that are maturing within 1 year just to smooth out the profile of maturities coming each month. So you don't want to have very lumpy months. Ideally, you kind of want to keep them a little bit more straightforward. It makes cash management easier. More details will be studied and released on what the appropriate sizes are. Currently, it looks like it would be close to 10 billion a month for each of the two programs. How much of the minimum float should be left in the market before you kind of start adding dysfunction, and all sorts of like frequencies and bucketing of purchases. So there's still more work to be done, but it looks like buybacks are coming next year. So it's sufficient time to study, but also not like super far out in the future. And finally, some of the discussion were around like whether tip sizes should be increased. Looks like they will be. That was TBAC was charged with studying that issue, and the other final thing was whether 2s, 3s, 5s, and 7s should be converted into auctions, which in the style of 10s and 30s. So new issue with taps as opposed to new issue each month. Looks like that might come, but these might take some time to kind of study and research.
I like the use of the word study there. Lots to think about then. Well, I was going to say in the weeks ahead, but really then in the months ahead. Okay, Giles, let's switch over to Europe then, because of course it wasn't just the Fed. We also had the ECB this week. We're recording this on Thursday, right after the meeting. So I guess listeners can just keep that in mind when we're thinking about sort of market reaction and what we've seen. They did hike 25 basis points, as was largely expected. I suppose there was a little bit of, well, the market was pricing in a small chance of a 50 bip hike, but regular listeners and readers of our research will know that 25 bips was in line with our expectations. What were the other key takeaways already then from today's meeting, Giles?
Listen, what else did we get from the ECB? We got an announcement on QT, which will now end for the APP. That is, APP reinvestments will now end in July. We were told that there was kind of light forward guidance of the what we call Delphic variety. That is, they, according to the information that they have today and so on, they think that there will be one or two more hikes. Okay, and I think that this was one of the key things that we had from Lagarde. That was a very strong and repeated emphasis that this was not them pausing. I think because in view of the market reaction to the Fed last night, that this was the end of the Fed. They wanted to make very clear that they think that there's one or two. And I say one or two because there was particular emphasis from her on the sentence which reads, "The Governing Council's future decisions will ensure that the policy rates will be brought to levels sufficiently restrictive, blah, blah, blah." And she, was very insistent on this, decisions plural. Okay, so at this stage, I would say they're trying to keep us focused on the possibility that we have both a 25 basis point rate rise in June and July. So that was the kind of the forward guidance plus sort of data dependency around that. Against that, they recognized, as they should, of course, that the lending data, and in particular the bank lending survey, was pretty awful, and so they've described that as forceful transmission into financing and monetary conditions. And finally, the other thing that some people were looking for, I'd say it was a bit of a minority view, but there was some risk, I think, that they might have provided some new bridging loan facility or talked about some strategy to bridge over this TLTRO cliff edge, whatever you want to call it, at the end of June, where 477 billion of this big TLTRO that was launched in the pandemic rolls off. Now, basically, they didn't provide that. They were talking about the other facilities that are already there, they're just not used, like the weekly MRO operation and so on, as potentially sufficient. But they promised, of course, as they always do, that they'll do something if they need to. And just finally, there's a question about PEP QT. So as I'm sure most listeners know, PEP, the PEPP is expected, or what they're telling us is that they will continue to reinvest their holdings in the PEP until the end of 2024. And there was no change there. Not that necessarily means that there won't be in the future, but it's not on the radar at the moment.
So you talked about the fact that, Lagarde quite obviously opened the door to the fact that it might not just be one more hike in June, there might be additional hikes after that. We officially had in our forecast a 25 basis point hike today, and then one final 25 basis point hike in June. How are you left feeling about that view now? Do you think that is under question? Is it just completely data dependent? How do you feel?
I feel perfectly fine with that, to be honest with you. I mean, our base case, as you say, was that the peak in this cycle would be would be 3.5%. You know, I think that is tracking reasonably well. Obviously, it could be a little bit higher, in line with this guidance from Lagarde that, given what we know at the moment, maybe there's a couple more rate hikes. But no, that's not our view. We think that actually, and you know, I think it bears emphasizing. I think that the turnover in lending and the tightening in lending conditions will catch up with the ECB before July, and I don't think that the summer hike will be needed.
And how does that fit versus the market then?
Well, I mean, markets, yeah, they're pricing kind of 3.6 to 3.65%. I mean, in that area, which seems about right, to be honest with you. I mean, maybe a little bit high, but I wouldn't particularly quibble with it. I mean, it's they're definitely in line with more or less kind of skew of risks of what I was just saying. So, in terms of what markets are expecting for the short term, no real disagreement there. For the slightly longer term, I mean, what we've really seen today is that the front end, beyond sort of September, has really kind of gone off to the races. I had been talking about about front end steepeners as a trade that I quite like the risk reward of in recent weeks, and that has been blown out of the water, sadly. I guess I wasn't realistic about how directional trade that was, and I think what we're seeing at the moment is that after the Fed last night, it doesn't matter that the ECB is telling us that rates are going to be continuing to rise a little bit further. The pause is there. It's projectable. We can sort of feel comfortable that we know more or less where it is. And so what what you see is that we've got 100 basis points priced in from the Fed cuts over the next 5 meetings or something like that. And the natural thing is to price in some rate cuts elsewhere in sympathy with that. And I think for the time being, it's going to be very difficult to go against that. That said, we are seeing the long end selling off. So as I speak, we're seeing the front end rally quite a bit. As I say, I think this is people putting on the steepeners that they've kind of been waiting for the pause to go into. But I'm a little bit surprised by the long end selling off quite as much. I mean, and that's accompanied with quite a strong periphery underperformance, which I get, because that's a sort of QT acceleration trade. We know that the ECB has been buying quite a bit or been overweighting quite Italy and Spain a reasonable amount, and so you can see the way the market's thinking about that. I'm a little bit surprised, just because I don't think that anyone really believed that they weren't going to accelerate QT in July, and so I would have thought that would be in the price to a greater extent, to be honest with you. So while that is in line with our long-held kind of more bearish steepening view, I'm a little bit surprised at how strongly that's been playing out just at the moment. I guess for you, the big question is that next week we've got the Bank of England. So maybe you can just talk us through your expectations for that.
Yes. I'll keep it brief because I think that we are probably very much in line with consensus, or certainly in line with market pricing. So we, along with everybody, I think, expect a 25 basis point hike next week. I guess it's worth noting that is a revision up to our bank rate forecast after the stronger than expected wage inflation and CPI data last month. So I think we, with just about every other sell-side analyst on the street, added in an additional bank rate call to our view. So one more hike to 4.5. Sorry. We expect that to be delivered with a 7-2 vote. So that's with the two doves, Tenraro and Dingra, dissenting for unchanged rates. Possible, I suppose, that Tenreiro votes for a cut. Not necessarily probable, but perhaps she would like to register a vote for a cut before she leaves the committee. Although given, we know that she's leaving, we know her replacement, I don't think markets will take that much of a cue from that. On the guidance, and perhaps this is where we sit a little bit more dovish than market expectations. And I'm inferring this only from the kind of pricing that the market has beyond May versus our expectations that this will be the last hike in the cycle. We do expect the guidance to be diluted somewhat. At the moment, they talk about, if they see evidence of further persistent inflationary pressures, then further tightening will be required. But I think that they can perhaps sort of counterbalance that or add a symmetric other side to that statement that kind of recognizes the risks, I suppose, in both directions now to bank rate as we near or arrive perhaps at that peak. This is one of the quarterly monetary policy, the MPR meetings, so we will get updated growth and inflation forecasts. For completeness, I suppose, we expect their growth forecast to be revised up slightly, and inflation on their market rate assumptions in the near term will be broadly similar. So that's the 2-year point, sorry. But on the 3-year point, we think that they will be revised up from 0.37 we had last in the February vintage to 0.7% we think this time around. And that's largely just, I guess, we've had this upside surprises on inflation, which are indicative of kind of underlying strength and underlying persistence in the inflation outlook, which is offset marginally by more bank rate rises being priced in, and also a rise in trade weighted sterling. So the reason why I said I don't think they matter all that much is just because since the kind of middle of last year, those forecasts have been painting a different picture, I suppose, to what the bank's reaction function has ultimately been. For a bank that's targeting 2% inflation over the medium term, if they're forecasting inflation well below 2%, you might be asking, when are they cutting rates? Yeah, they've been consistently delivering hikes. And so their kind of bearing on monetary policy and therefore on the market reaction has been quite limited. And that's largely because the Bank of England themselves has told us they have quite little confidence in their forecast, but certainly they view the skew of risks so heavily in one direction that they've kind of continued to hike. So I think the market reaction will be driven much more by the size of the hike, although I'd be very surprised if it's anything other than 25 basis points, and therefore B, the vote split, but perhaps most importantly, the way in which they change or don't change the forward guidance.
Okay, right. So maybe just worth relating all of that to what the market's saying in a minute.
Yeah, so I guess what that really means for markets is that it feels like there's a high bar for the Bank of England to out-hawk this market. The market's got 25 basis points priced in for next week, but then an additional kind of 40 to 50, depending on which moment of the day that you look at it beyond there. But still, more than at least one more hike after May. So it feels to me like, either they hike rates 25 basis points and the vote is something like 7-2 and they keep the guidance unchanged, which is a slightly hawkish scenario, I suppose, versus our base case. But even that doesn't necessarily give the green light to, hiking in the kind of scale and speed that the market is still expecting. And on the flip side, they do dilute the guidance, which I think vindicates our view that perhaps this is the last hike in the cycle, but certainly sort of goes against market pricing that there's another at least one and maybe more hikes to come. So it feels to me like the risks are skewed a little bit one way in terms of this being a more dovish outcome for the market. And for that reason, I would push back against the peak of kind of somewhere between 4.8, 4.9 that the market's pricing in by September.
Okay, maybe just one last question. I want to draw you out a little bit on something that we've been talking a lot about on the desk. this week, which is that one key theme has been UK underperformance. Has really been quite remarkable since over the last couple of months. So maybe you can talk a little bit about that and whether you think that's going to correct or not.
I guess there's two elements to this. We've seen UK underperformance kind of across the curve, so at the front end and at the back end, and they're perhaps being driven by slightly different things. I think at the front end, maybe you might point to the fact that we've had upside surprises in inflation, as I just mentioned, over the last couple of meetings, and therefore slightly more evidence of persistence in inflation. And you might point to the fact that data, coming from a very low base in the UK, and certainly recognizing that we're talking about still very weak expectations, but it has started to surprise to the upside. If you look at things like the economic surprise index on Bloomberg, you can see that the UK has really turned a corner versus other countries. So from a relatively low starting point, in terms of spreads to other countries, they may well have been part of the driver of underperformance of UK rates, but probably don't tell all the story of why UK rates are still priced for at quite high levels versus what we see in the US and Europe, for example, and really why doesn't really tell the story why the UK hasn't participated in this sort of global front-end rally that we've seen over the last kind of month or more, and to put that into context, I suppose I should have said this earlier, but to put that into context, we've seen one year in the US rally something like 140 basis points since the early March highs, and we've seen sterling rally just about 40 basis points. So whilst that better than expected data or higher than expected inflation data might cause some of that spread widening, you probably wouldn't have expected the UK to stay so high. I think part of that front-end story may well be about mortgage-related paying. We've seen, although the mortgage data is a little bit lagged, we have seen a tick up in the proportion of mortgages that are fixed for 2 years versus 5 years. That's gradually been trending down over a number of years, but actually in the last quarter, we saw a fairly significant tick up. And so some of that level of UK rates may well be related to mortgage paying at the 2-year point that's keeping those rates elevated versus other countries. At the back end of the curve, I think it's a supply story. And that's kind of why I was laughing, because I know that we've spoken about that so many times on this podcast. So I don't need to repeat myself there. But I do think that, broadly speaking, we've had a relatively heavy supply calendar in the UK over the last couple of months, and that's set to continue. So I do think that long end underperformance has further to go, but I think perhaps at the front end the underperformance has gone a little bit far now, and we may well expect to see some of that reverse, because like I say, the fundamental factors, the inflation and the growth outlook, don't necessarily justify rates as high as they are. And although some mortgage related paying may well be keeping front end rates high in the UK, it perhaps doesn't explain all of that kind of 100 basis point spread to the US, or in terms of the move that we've seen over the last couple of months. Let's leave it there. We can catch up next week after the Bank of England. And of course, once we sort of fully digested the market reaction to the ECB today, and I'm sure any sources stories that may well come out in the hours afterwards. Thank you guys for joining me. And thank you to our listeners. And just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.